Hey everybody, welcome back. My name is Matthew. Thank you for joining. Today we're continuing on with the M3 money supply for the United States. Now, in the last video, I showed you the first two components of the M3 money supply, namely institutional time deposits and institutional money market funds. They are the broadest form of sort of basic M3 money, and you see that delineated by the green number 3 here. And we see that as of June 2024, we're at about $28 trillion in M3 money. Now, the next two components of M3, traditional M3, and remember, the United States Federal Reserve has not published M3 since February 2006. The next two components are a little bit more interesting and a little bit more complicated. The first one is repurchase agreements. The second one is Eurodollars. We're going to take these both in turn during this video. So repurchase agreements. I've talked about this many times. I'll link a few prior episodes in the description below. But just to reiterate what a repurchase agreement is, first of all, remember, we're in M3 money. It still exists, even if the Federal Reserve doesn't calculate it. And M3 money is indeed less liquid institutional type deposits, okay, where the cash-like instrument cannot immediately be turned back into physical cash, M0 type money, but certainly you can do cash-like things with it. So repurchase agreements, since, again, Paul Volcker and many of the early Fed economists in the 50s and 60s started delineating these money supply stacks and tranches, M0, M1, M2, M3, so on and so forth. This has been around since the beginning, a repurchase agreement. So what is a repurchase agreement? Very, very basically, it is a Treasury security that one institution owns and another institution decides to borrow in order to do different things. Another way of saying that is that it is a Treasury security that trades like cash. And in order to trade like cash, it needs to be levered up. Okay? Here's a very simple example. Remember in this light green area of M3, which we are currently showing, a part of M3, we have money market funds. Okay? Money market funds are just a huge component of the United States financial system. They're kind of like a stable coin in that they invest in treasuries, and their instruments that they issue, namely the NAV, it's a dollar value instrument that usually trades right around $1, just like a stable coin. Okay? Money market funds could get a good or a better deal than just holding those treasuries for their NAV. If another institution, for example, a hedge fund, comes to them, says, hey, Mr. Money Market Fund, we see that you have treasuries here. We see that you're getting an interest from, of course, the treasury. Treasuries are bonds. Money market funds are just holding them to cover their spread for the NAV. And they say, Mr. Money Market Fund, we would like to borrow those treasuries in order to do things with it. We might want to short another market entirely. We might want to short the Japanese yen. We might want to go long the Swiss franc, or we might want to even buy a bond in another country, whatever it might be. The hedge fund says, Mr. Money Market Fund, can we please borrow your treasuries? And usually in a very short time period, overnight, for example, could be weekly, could be monthly even. Can we borrow your treasuries? And then we will pay you back a rate of interest. And so the money market fund then has to look at the deal and say, is this worth it or not? Because the money market fund's already getting interest from the treasury, okay, at a constant stream. The hedge fund is coming with another deal, but it's a leveraged deal, okay? And so the money market fund just needs to decide if they want to swap the regular treasuries for a repurchase agreement, okay? And the repurchase agreement is coming from, for example, in this case, the hedge fund. So the hedge fund says, don't worry, we're going to take the treasuries, we'll pay you back the treasuries plus some interest tomorrow, for example. And the money market fund says, fine, maybe we'll swap and we'll do that agreement. So the money market fund loans the treasuries out. The money market fund had the treasury already as an asset. It's just swapped its assets. So now it has loaned those treasuries out to the hedge fund. The hedge fund now has created an asset and a liability. From nothing, money has been created. This is how money and credit works. There was nothing before. A repurchase agreement has been created by the hedge fund, where they now have a new asset and a new liability on their balance sheet. The money market funds just swapped assets, but the hedge fund has created an asset and a liability. What is that? Well, the asset it has is that Treasury, took it onto its books. And the liability is the loan to pay back the Treasury. Okay, I said I was going to be simple about this, but this is as simple as I can make it for repurchase agreements. What happens during that day, overnight, during the next week, the hedge fund works to make more money than the interest it's going to pay back the money market fund, for example. Okay, so it might be shorting the yen, long Swiss franc, whatever it might be. That's a repurchase agreement. They're very deep liquid markets, and they've been around for a long time. I told you this is the third component of M3, and I've separated this out because we need to, it's an important topic, but also we need to break it out a little bit more. So look at the old M3. Remember, it was discontinued in February 2006. It's the tomato line right here. We see it was discontinued at $10.3 trillion in 2006. But just like with these earlier components with M3, institutional time deposits, institutional money market funds, the data still exists. You just got to go find it. Federal Reserve, also in light of the global financial crisis, had to do much more work on publishing what they knew about the repurchase agreement market post Dodd-Frank, post GFC, and they've done that. I'm going to put a link to this exhibit in the show notes so you can see exactly where I'm getting this data. It's from the repurchase agreement exhibit from the Federal Reserve, and you can back into what the supply of repurchase agreements is around the United States dollar money markets today and going in the past. And I've done that, and this is now going to be in the lightest shade green here with the black 3. This is the next component of M3. It's here. Again, this is still an explainer video. I'm not going to do too much about implications of this. But we can see the lightest component of M3 now over the green M3, which I had, the green number M3 on the chart, is $28 trillion. We see M3, including repurchase agreements, which I just explained, $33.8 trillion. Okay, so just right there we can see $5.8 trillion market, $5.8 trillion repo market at the current situation, June 2024. But go back here, before the global financial crisis. Remember, I showed you the tomato line. It was the old Federal Reserve M3. Do you notice anything? You notice that my revised, backward-looking M3, based on the Federal Reserve's own numbers that they started publishing post-GFC, is higher than the Federal Reserve's old M3. This is very interesting. There are a few conclusions we can draw here, but a very important one is, let's ask ourselves, why did the Federal Reserve stop publishing M3? In fact, ironically, 2 years before the global financial crisis. One possibility is the Federal Reserve was looking at the repurchase agreement market and seeing that their internal data was spreading farther than what they had been keeping track of in the past. Why? Well, firstly, the Federal Reserve, based on my understanding of the data, was only keeping track of repurchase agreements that banks did. But repurchase agreement market took on a life of its own in the last 20, 30 years before they were even calculating this data. As you can see, it's already bigger than their M3 number here, using their data actually all the way back to the beginning. And remember, this is just repurchase agreements as this extra layer, not even including Eurodollars, which is another thing. So what it's telling you is, based on the data that they've revised and started publishing more in depth since 2012 or so, and you really have to work through this data a little bit to put it together. We can see that looking back, let me zoom back in from here, let's say, before the global financial crisis, the repurchase agreement market was already getting out of hand, getting much higher than what they were estimating. And they could, of course, see that. They could understand that the money market funds, the hedge funds, other non-bank entities were repoing. They wanted a little bit more interest, a little bit more risk. So they were repoing, they were rehypothecating, they were layering more contracts on top of these basic government securities than was previously thought. And so one conclusion, and Mr. Barnett, a former Federal Reserve economist who was very good, and I've mentioned him before, I'll link to a video from him in the show notes. He said one clue why M3 was had stopped to be published after February 2006 was because M3 included repurchase agreements. Taking a moment to remind you that this show is brought to you by Trezor, home of the original Bitcoin hardware wallet. For over 10 years now, Trezor means business in Bitcoin security and functionality. When using their wallet software Trezor Suite to connect to the Bitcoin network, you're automatically connected via Tor, protecting your identity and giving you full control of your coins in a fully open source manner, both on the software level and on the hardware level. So head on over to Trezor.io to grab your brand new Trezor Safe 5 with a secure element, as well as a ton of available accessories to back up your keys and keep your coins safe. And they stopped publishing it. That's it. So again, even though the data is there, of course, these markets continue. The Federal Reserve has said that they don't think that there's any significant economic activity to track. It's very strange. So here it is. I have now added another component of M3. We now have 3 components of the traditional 4 components of M3 in this black numbered 3 on the chart. Another interesting thing we can see here now, this is a little small analysis again. Before the GFC, before the crisis in 2008, from about March, April, we see a very wide spread between not just the other parts of M3, but M2. And let's take out the other parts of M3, the time deposits, the money market, the time deposits, the money market funds. Let's just put them all together. M3, you can see it. This is my revised M3. You can see it very clearly. Before the GFC, there's a very large spread in M3 to M2. 16.5 trillion in M3 versus 7.7 trillion in M2. Where just, 5 years prior, the spread was only, let's say, $4 trillion, you see? This is my M3, not even the Fed's M3, but my M3 versus M2, $4 trillion. And then a couple years later, 4 or 5 years later, that spread is now 16.5 trillion to 7.5 trillion. It's close to 9. It's close to $9 trillion spread. It's a very interesting clue into how the global financial crisis could happen and, why it happened. Okay. Whoops, this one shouldn't be on there actually during the video. If you've been paying attention, you got a little bit of a taste for the final thing I'm going to show here. We see it retracted. Okay. Did money supply can shrink. People can shore up overextended bets. And indeed, it did shrink my M3 after the global financial crisis, but then grow again. And it grew again at the same clip as M2 here. And then COVID happens. And now, interestingly, we can see, again, this M3, including repurchase agreements, the spread is widening. It's widening again. Now, I don't know if that's portending another financial crisis. Everybody is always predicting a financial crisis. This is just one indicator. And I will continue to analyze this in the future videos here on the whole United States public-facing money supply. But we see a spread here from M3 over M2 happening before the GFC. And again, the spread of M3 over M2, we see it happening right here just in the last couple of years. Okay, something to pay attention to. One more thing to say about repos. The Federal Reserve has also now gotten involved in the repo market in a big way. Okay, so just like any institution, remember this is institutional type money, can lever up treasuries, trade around treasuries like cash in a levered manner to do other things, to short, to long other assets, whatever. So can the Federal Reserve. And why would the Federal Reserve do that? Well, the Federal Reserve doesn't take on other risks like shorting the yen or going long the Swiss franc. They could, but they don't. Okay, so why would they do it? They would do it if the market is uncertain about what is happening and they want a Fed-like asset on the other side of their trade. Now, again, repos typically are not for banks. Banks, when they want safety, they get bank reserves. Bank reserves are this black negative value here that's the underbelly of the financial system, symbolized by the vault, okay? The vast majority of the vault number here, all right, which again is part of the monetary base, 3.5 trillion as of April, May, June 2024, 3.5 trillion in bank reserves. See that it peaked in around 2021 at 4.3 trillion dollars. Banks can just go into federal funds whenever they want and hold them. And indeed they have since the global financial crisis. What can non-banks go into as far as the Federal Reserve goes? The answer is actually a repurchase agreement. Just like I talked about with the money market funds, a money market fund could say, hey, Mr. Hedge Fund, you're too risky for me. But since I'm not a bank, I'm not privy to bank reserves, I'm going to do a repo with the Fed and take even more safety. And so the Federal Reserve has offered that. And as part of the great monetary inflation that happened during COVID, I'm going to add another repurchase agreement statistic, but it doesn't go up in the light green shaded area as I've drawn here, the public facing money. It goes down into the Federal Reserve's liabilities, which are negative because the Federal Reserve is the core of the system. I'm going to draw that here. Okay, so this darker gray area, not black, delineated by this sort of institutional icon. You see it here. It's the total value of bank reserves plus Fed repos. It's a lot of data here. I'm just trying to layer it on as concisely and logically as I can. It's delineated by this black institutional icon here in the dark gray total. So we see, just to pick a number, October 2022, bank reserves $3.1 trillion. If you add on Federal Reserve repurchase agreements, it's $5.6 trillion. It shows us the Federal Reserve is repoing with non-banks and banks, but mostly non-banks, to the tune of $2.5 trillion in October 2022. It was a huge balance sheet item for the Federal Reserve. Now that has actually contracted in the last couple of years as interest rates have gone up and money market funds have been dipping their toe back into the market of, again, hedge funds, other institutions to lend their treasuries to. It's come down. So you see the spread now. Look, the spread here was, again, look at the bank reserves plus vault cash, the main money for the banks, $3.1 trillion in January 2023, $5.5 trillion if you include Fed repos. That means $2.4 trillion in Fed repos. All right. That spread is now closed. Not fully, but a lot. Where in June 2024, you see vault cash is up to about $3.5 trillion, Fed repos 4.3 trillion, plus the bank reserves itself. That means the Fed repos themselves isolated about $900 billion. So the spread has narrowed from 2.6 trillion to 900 billion, but it's still there. But then, of course, where has the rest of that repo money gone? It's gone back into the market. And you can see that by that widening number 3 spread in my M3 money supply, where in December 2022, M3 was 31 trillion. Now in June 2024, $33.8 trillion. And the spread is well over 13, close to $14 trillion over M2. This is how you build up the public-facing money supply. The data is there. The Federal Reserve even publishes still to this day much of the data. You just have to work through it. You have to put it in the right position of the balance sheet, whether we're talking about the Federal Reserve. Its liabilities are negative on this chart. Or banks, hedge funds, money market funds. Those institutions' liabilities are positive on this chart. And here we can then see what money becomes. Money, a fiduciary media asset, is always a liability. Doesn't matter how you count it up, whether it's the Federal Reserve or institutions like banks, institutions like money market funds who can repo assets and rehypothecate assets, who can have large time deposits from banks. All of that money is a liability on the fiduciary media stack, which we've drawn, and I'm putting that as a positive number. And then the core of the system, where they want to retreat to, where they want to go to, the lender of last resort, that's a liability for the Federal Reserve. And I'm delineated that as a negative number on this chart. So again, we're not going to go too much into the implications of that. We will measure those ratios in the next couple videos. I just want to show you, and as I've showed you in the last few videos, what these money supplies are, how these money supplies look like, and how they work together. Hopefully that has been clear for you, and you've had a better understanding of the way the money supply works. And finally, to close it out, we have the fourth item of the traditional M3 money stack, which is not here at all, okay? And that is called Eurodollars. What are Eurodollars? They are offshore dollars. Dollar balances, dollar account balances, whether they're in Panama or the Bahamas or in the UK. They're in banks that are outside the jurisdiction of the Federal Reserve. That's called a Eurodollar. It's a concept that goes back to World War II, when many European banks, particularly Western European banks, were rebuilding themselves after World War II, and they wanted safe balances. They wanted dollars. That's why it's called Eurodollars. But it doesn't have to be just in Europe. It can be in Japan, Korea. Dollar-denominated accounts outside the jurisdiction of the Federal Reserve. It can be in the Caribbean, Eurodollars. That is, so far, for me, on this channel, incalculable. It's incalculable. It's a probably much larger figure than most people think, and I just don't have it in my M3. We can see that the Federal Reserve's tomato line, which ends in February 2006, they did have a Eurodollar figure. It was about $1 trillion or so, if I recall correctly. Not much. But again, just like with repurchase agreements, I am surmising that they were way undercounting that. You can look at news stories of things like the Panama Papers, Paradise Papers. There were tens of trillions of dollars of value in these stories, in these leaks. It doesn't mean that all of them are euro dollars. Okay, they still might be stock certificates or money market funds. It might be something else, but the euro dollar account balance value is certainly a part of that story. It just means if someone has a deposit account with some bank in the Bahamas and they say, look, I want it to be in dollars, there's nothing stopping the bank in the Bahamas from offering that. Now, that might seem crazy to you, but that's just how banking works. If you want to put your money there, it's a question of your own due diligence of how strong that bank in the Bahamas is, how strong its assets are. Maybe it has dollar-based assets, treasuries, to balance out its deposits, its liabilities to you, the depositor, the owner of a Eurodollar account. But that's just how it works. There's nothing magical about it. This is banking. This is fiduciary media. You need to understand that first before you want to go in and criticize the system, of which I have done plenty of that myself. Okay? So that's going to conclude it for the just observational latest update of the monetary stack of the United States. I'm going to put it up to June 2024. Let's just start at the bottom. The Federal Reserve's balance sheet, its main monetary liabilities, including repurchase agreements that it owes to money market funds or other hedge funds that have assets on their side of the balance sheet, with the Federal Reserve having the liability, you're looking at $4.3 trillion. You take off those repos, look only at the bank reserves, only for banks with banking licenses. That's the part of the monetary base that's in the banks, $3.5 trillion. Those are the main Federal Reserve liabilities. Then you go into the public-facing money, the M0, which is still part of the monetary base. M0 is the physical cash and coin that the Fed and the Treasury have outstanding, $2.2 trillion in cash. That's physical cash and coin. Remember, the Federal Reserve is notes, the Treasury is coins, but it's all put together for the monetary base. Most central banks around the world do cash and coin. It's another topic. Then you have M1. M1 is, again, M0 plus demand deposits. It's about $9.7 trillion outstanding liabilities. Then you have M2. You're going to add on less liquid retail type deposits, time deposits, retail money market funds. You're getting up to a value that's $21 trillion or so. Then you add on the three components of M3 that are able to be relatively easily calculated from Federal Reserve data: institutional time deposits, institutional money market funds, and the levered up institutional repurchase agreement. US dollar balance, nearly $34 trillion in M3 today. Hope you enjoyed that. Thank you very much for watching. Take care.